Well, a warm welcome to everyone and thank you for joining us today. My name's Joel Carty from Solace Financial, which is a locally owned and locally staffed firm here in Brisbane. Today we have Carty Drysdale from Fortlake Asset Management. Carty is a portfolio manager at Fortlake and a PhD candidate at the University of Sydney, focusing on AI for fixed income portfolio optimisation. She has a Masters of Data Science from the University of Sydney with a thesis on quantitative easing in the Australian bond market. Carty has research experience with Dr. Christian Bayliss, who is also a colleague at Fortlake. Her professional background includes roles at ANZ and Dimensional Fund Advisors, where she gained experience in domestic and global fixed income markets. At DFA, she worked in trading and portfolio management, incorporating sustainability into the investment process. Carty also has a teaching background in economics and business studies and continues to educate postgraduate students at the University of Sydney. But before we get stuck into our discussion, I'd like to quickly provide a general advice warning. As we go through today's discussion, we'll be discussing financial information which is general in nature, meaning it doesn't take into account your own objectives, financial situation, needs. So it's not a recommendation. It's important to consider if what we discuss today is appropriate before acting on it. Also, please refer to any product disclosure statement regarding the financial product for further information. Details of this general advice warning can also be found at the moneysmart.gov.au website.
Well, thanks for joining me today, Carty. As a fund manager specialising in fixed interest, can you talk us through Fortlake's asset management's history and investment philosophy?
Yeah, absolutely. And thanks for having me today, Joel. It's a pleasure to be here talking to your clients. So Fortlake started in December of 2020, and it was started by Dr. Christian Bayliss. So he is our founder, he's our chief investment officer. And the reason why he started Fortlake is he has quite a bit of experience in fixed income from doing sort of credit analysis, working at the RBA, working at UBS. And he had this vision to think differently about fixed income. And so what he wanted to do is bring all of the components of fixed income together. So that's rates, that's credit, that's inflation, default arbitrage, whatever it is. He wanted to bring that all together into one sort of holistic approach to fixed income, where we can use fixed income as a universe and a conduit to deliver a financial outcome for investors. So if we look at a lot of traditional managers, they sort of silo those approaches. You'll have a rates team, you'll have a credits team, you'll have an inflation team, and so on. Whereas at Fortlake, we bring all of that together, and we really sort of what that means is we end up with a kind of well-synthesized, holistic kind of approach to fixed income that's also non-correlated to your other traditional fixed income.
Okay, sounds quite a complex overlay there. So what's the investment process you guys use then?
Yeah, so the process that we follow, I think it really sort of, it probably is best to start with, well, what's a day in the life of an investment team member at Fortlake? I think the best way to start is usually it's waking up, looking at what's happened in US markets, what's happened in the late European session as well. And then from there, I spent a lot of time doing a lot of quantitative analysis and bringing all of that quantitative analysis into a kind of a daily run sheet. And then we have a meeting as a team every single day, and we run through what's happened in markets, what's the current risk profile of our funds, where do we see opportunities, and we bring all of that together to come up with investment ideas, and then we'll look to execute, potentially later in the day, if there's an idea that everyone on the team kind of agrees on and thinks there's value in adding to our funds. So it's very much, we do rely a lot on that quant analysis, so data mining, data aggregation, a lot of processing, and then sort of signal generation. So that kind of gives us prompts as to where we might look, but then we have that sort of professional practitioner oversight that's kind of looking at all of those sort of pieces of information, bringing it together, and then looking at how we can express that in trades in the market.
Okay, you mentioned risk. So how would you assess risk when you make the investment decision?
Yeah, so we operate very much on what we call a trade meritocracy framework. So whenever we come up with a trade, we are always looking at the risk adjusted return of each trade that we're looking to do. And so we might have, 10, 20 ideas that we're playing around with, but we kind of rank them based on that risk adjusted return. And so the way that we kind of think about risk, it's sort of multifaceted. So we use those traditional risk analytics. So we're looking at, your duration, we're looking at credit spread. We do a lot in non-linear fixed income. So what that means is options. So we have to look at sort of traditional Greek analytics of our portfolios. And so we get those every single day in real time. We get them across each trade. And we also look at the risk of each of those components aggregated across the portfolio. So we're doing that, every single day. We do that in our kind of order management system. We also look at our risk via Bloomberg and a number of other platforms. The other thing that we do in terms of managing risk is, like I mentioned earlier, any trade that we have that we're looking to execute, it's been run by multiple members of the team. So there's always eyes on every trade throughout the idea generation process, but then also throughout the execution process. So you might have Christian executing and I'm looking on, vice versa. So there's always a couple of sets of eyes, and we're very, very rigorous about that.
With the execution piece, is it discretionary rather than systematic?
Yeah, so we're very much of the opinion that a lot of traditional fixed income managers, they will focus on coming up with great trade ideas, and then they might execute in the market, and then they take a big bit off a spread that kind of erodes that fantastic idea and that value that they've generated initially. So we are very focused on making sure that transaction cost doesn't erode the benefit of the trade as a whole for the portfolio. So we don't have to trade at any given time if levels aren't where we like them. If markets aren't liquid enough, we can step aside and we can find other opportunities. And like I said before, if there's a kind of theme in the market, so whether it's negative swap spreads or credit spreads being particularly tight, we always have a number of different expressions or sort of trades that we can put on that capture that dynamic. So if there's one that doesn't work when we're executing, we can look at the others. And so there's always kind of a backup process, I suppose. That being said, though, that we do typically operate in highly liquid markets. So we gravitate towards clear derivatives. We gravitate towards exchange traded derivatives. We're very much kind of focused on that area. So often we find when we are transacting that it's not prohibitive, that bit off a spread. The other thing too is, as a team, because we have multiple team members, we have some quite strict guidelines around execution and what sort of bid offer spreads we do accept for any given trade. So there's processes in place to around the trading kind of process, but also around that risk management process.
All right. So, Carty, you spoke about opportunities. Can you elaborate more on the opportunities and risks you see in the market at the moment?
Yeah, absolutely. So I'll start by talking about risks. And I think, what is a risk is also an opportunity, but let's start with the risk. So we're very mindful of the high yield credit space at the moment. If you think about all of the fiscal support that's been transferred to businesses since COVID, and that's continued on, and we're still seeing that kind of support of unproductive businesses and productivity numbers staying quite low. We think it's just a matter of time before we start to see, because of the withdrawal of that stimulus, we start to see stresses come through and we start to see defaults come through in capital markets. And it's really evident in a lot of leading indicators. So one of those leading indicators is small business bankruptcies. So we have access to data sets that show that we've got huge rate of bankruptcies in small businesses that aren't quite large enough to have bonds outstanding or sort of other fixed income products outstanding. And we think that that is sort of the canary in the coal mine to what we might see in capital markets. And so that is a risk, but what that means is that we can go and then buy protection against defaults in high yield names. So we do have that kind of bought protection position against that at the moment.
Okay.
Yeah.
So it's kind of taking long and short positions.
Sorry, say that again.
It's kind of like taking long and short positions.
Absolutely, absolutely, yes, yeah. So what we'll do is we'll buy protection in a credit default swap index, but then we might go and sell protection in a tranche. Now, for those of you who are unfamiliar with tranches, if you look at a CDS index, it might be made up of 100 names. Sometimes it's made up of 75 names. And what you can do is slice that index up into what we call tranches, and you can buy or sell protection in those individual tranches. So an example of a tranche might be a 0 to 10. And so what that tranche is you're either buying or selling protection, depends on your direction, in the first 10 names to default. And then there's a 10 to 10 to 25 tranche, 25 to 35, 35 to 100. And so what you can do is you can buy protection for on the overall index, and then you can go and sell protection in a tranche, which is say a 35 to 100. Now, if you look historically at the rate of capital market defaults, we've never seen 35 defaults in a particular index. So what you can do is you can go short on the index, and then you can go long on the tranche. And what that means is that the cost of funding is also reduced as well. So there's just a couple of things that we do to play around with that risk that's in the market at the moment.
So you've spoken about the flexibility in the strategy in the team.
Yes.
So that seems to be some of the strengths of Fortlake. Are there any other strengths that you guys have as a fund manager?
Yes. So I mean, I think plenty of strengths. Of course, I'm biased, but I think our non-correlated profile to traditional fixed income and equities is something that's particularly attractive to investors. The other thing too is we are inherently, as a team, a knowledge service. If you look at Christian's background, his PhD, I'm also studying my PhD. We've got a very quant focus. We are also operating in a market that is where there's 20 people in the world that can do what we do, or that look at the markets that we look at, and so we see that as a competitive advantage, but also a huge barrier to entry. Now, the barriers to entry in our space are very high. If you look at the cost of setting up, the cost of we've got CDs, we've got ISDAs, we've got all sorts of legislation, we've got the cost of trading platforms, et cetera. Huge barriers to entry from a cost perspective, but also from an intellectual capital perspective as well. And so I think that's something that really sets Fortlake apart. The other strength too, which you alluded to in your question, is we have such a broad remit. So we can look at the entire fixed income universe. And so that means that we have so many different levers that we can pull to generate alpha in our portfolios. So that's something that really sets us aside, not having that siloed approach, having that very flexible, very nimble, very broad kind of scope of what we can look at in fixed income.
Okay. Can you talk us through a time when you've turned a period of poor performance into an opportunity and then turn the performance around?
Yeah. So this is actually quite typical of a Fortlake portfolio. In months where we have seen softer than usual returns, we are able to sow the seeds for future performance. I think a really good example of that is, end of 2023, when the Fed sort of changed from a tightening bias to more of an easing bias. What we saw was, spikes in volatility. Now, when we see spikes in volatility, that's actually the perfect environment for our funds. And so we were able to enter into positions that would bring through income in our portfolios for the following 3, 4, 5 months, even longer. And so what you see in our returns profile is we have a softer end of 2023, but we have a real kick of performance coming through 2024. So, we were able to turn around that around quite nicely. And that's something that, is also important to consider as we've seen this sort of sell-off in November in rates markets, and we've had a bit of a sell-off in the last week as well, just some strong US data coming through. What that inherently means is that yields push higher, and we're able to then lock in a higher running yield in our portfolios as well. So there are a couple of things that we kind of think about in terms of how can we use tougher times to lock in future performance.
Sure. So what type of investments or trades have you recently made?
Yeah, sure. So something that we really like, and we've liked it for a little while now, is what we like to refer to as a buy right strategy. And so that's where we will purchase corporate bonds or credit indices or whatever it is, and then we will sell a interest rate option or a credit option against that. And so what you then have is you have this long exposure coming through the purchase of a bond. You have that yield coming through, but then through selling an option, you also get additional yield coming through the portfolio. So you have this kind of almost like a long and a short that gives you this nice additional sort of running yield in a portfolio. So that's something that we're sort of constantly looking to do at the moment. And another thing that we're looking at the moment is, we've seen just with some of the market movements in the last week, changes in term premiums in the US. And so we're kind of thinking about, well, what's something that we can do looking at interest rate curvature.
Okay. And how do you stay up to date with all the changes in financial markets?
Yeah, I think that's a great question. I feel like in fixed income, there's just such an abundance of information. So, we have all of our brokers coming through. We've got about 20 plus brokers in the Aussie market. They're all coming through on Bloomberg. They want to have a chat. They want to talk to you about their latest research. You've got information coming through on emails. You have phone calls coming through. Then you've got mainstream media as well. Like, there's just a saturation of market. So I think the critical question is actually, well, how do you work out what's important and how do you aggregate that nicely? So we actually do a bit of machine learning. We do a bit of natural language processing that helps to kind of scrape a lot of that data and bring it into one kind of aggregated, digestible format. The other thing that we do too is we share ideas as a team. Like I referred to that morning meeting that we have every day. That's a huge source of staying up to date with different changes in financial markets, because everyone's going to be looking at something different. It's not physically possible to be across everything. So that's a good source. My phone has push notifications going off all the time with Bloomberg, with different sources. So that's another way to do it. But one of my preferred methods personally is sitting down and talking to our counterparties that we trade with. So we trade with investment banks, we trade with local Australian banks. And so that's a great way of getting what we call colour on the market, and just getting kind of unique insights that you wouldn't otherwise have. So plenty of information. It's just working out what sort of suits each individual as well, what makes them kind of engaged.
So what makes a good portfolio manager overall?
Yeah. I think so. Christian, as our founder and CIO, he actually has quite a tendency to hire people who have quite an athletic background. And I think the reason for that is that sort of generally is a person who has quite a high drive, who's quite tenacious. I think also someone who's prepared to be wrong. If you look at financial markets, you cannot be right all the time. You have to be prepared to be wrong and then able to, adjust accordingly. And also, I think, being okay to be wrong. And I think with that comes a level of emotional control, comes a level of learning. And also, for me, something that I've really come to appreciate in my time as a portfolio manager is bias awareness. And I think that's probably because of my data science background as well. I think to be a good portfolio manager, you have to be aware of your own bias in terms of market views. and just willing to take on a range of different opinions to inform your own. So yeah, I think sort of kind of bringing that all together, someone who's resilient, someone who's prepared to be wrong, someone who's constantly learning, and aware of their own shortcomings.
Okay. Now, we've covered a lot of ground this morning. Is there anything else that you'd like to add that we haven't already covered?
No, nothing at this stage. It's been a real pleasure to chat to you, and you know, if there's any questions that come from your clients as a result of this call, please chat to us. We're very keen to explore more about fixed income, because Fortlake, we are a very unique approach, and I think, you know, the more our clients know and the more they feel engaged in the investment process, the happier we are.
Excellent. Well, Carty, I appreciate you making the time to talk with me today, and I look forward to chatting to you again in the future.
Yeah, fantastic. Thanks very much, Joel.
If you'd like to talk to Solace Financial regarding your current financial strategy and whether it's suitable for your goals and objectives, please reach out and contact me via our website or give our office a call to schedule an appointment. Thanks again for your time, Carty. That was a great discussion, and I really enjoyed hearing about your experience and what you do as a portfolio manager.